you want to significantly lower the amount of taxes you pay, or even pay no taxes at all, and you're a young person with a little bit of money, this video is for you. So most people don't know this, but there's a quirky law in Canada, and there may be some of these laws in whatever country you're in. If it's the United States, if you're somewhere in the UK, wherever it may be, Australia, you may have one of these laws too, and you may need to look into this yourself. I'm just going to talk about what it is like in Canada. So there is this law where there are certain companies, there's a select few companies that are in oil, mining, renewable energy. There's companies like that where every dollar you invest into stock in that company, you get that exact same amount as a tax credit. This is something that is called Flowthrough Shares. And why is it called Flowthrough Shares? Well, this is because for a lot of energy companies, oil, mining, gas, all those that I already mentioned, they get tax breaks, but they're only tax breaks at the very top. They're only tax breaks for the business itself. What Flowthrough Shares is, oh, I didn't even spell that right. What Flowthrough Shares is those tax breaks, they go down to the shareholders and they go down to the people investing in the stocks. And so why would Canada do this? Why would your country do this? It's because any dollar invested that you invest in that company goes towards pretty much research and development. And research and development for oil companies is like pretty much trying to find new oil patches or trying to find a way to make themselves a bigger company. That's because that's what Canada wants. That's what most countries want. They want more access to energy within their own country. And so a lot of these times when an energy company is just starting out, they cannot get funding from the normal investors. So what they do is they get funding from maybe not so normal investors who want a giant tax break, like a lot of young people and a lot of wealthy people. Those are the two people that they target. This isn't for the middle class 45, 55, 65-year-old. This is for wealthy people and young people. And it's really strange how those two things, it's going to benefit those two kinds of people. I'm going to explain why here. So I'm going to give you an example. So I would just like to start here. So yeah, you can only, if you want to get this giant tax break that I'm going to talk about where you may not have to pay taxes at all for an entire year, including your income, you have to invest in young energy companies. So companies that aren't worth that $1 billion, ones that are worth $1 million, $10 million, maybe $100 million, like ones that are fairly small within your country. And so this is why it's high risk. Because these aren't your typical blue chip stocks, I will say that going into this, it is much higher risk than your typical Coca-Cola, McDonald's, the normal strategy that I go about when I invest in stocks. So the other thing too is that if you're going to invest like this, if you are going to invest where you don't want to pay taxes anymore, you probably will not see many gains from your investment apart from the tax break. So you're going to have gains. It's just going to be through not paying thousands of dollars worth of tax that you would normally pay. That's your gain. It's not from the company shooting up. I mean, it sure might. If you invest in an oil company and they find a nice oil patch somewhere, that could shoot straight up through the roof. So we're going to get started here on the example. We're going to start out here at year one in terms of investing. So there's one more rule I have to mention too, is every time you invest in one of these companies, you're locked in for a certain amount of time. So it's usually 12 to 24 months, and we are going to say 24 months, so 2 years for this example. So year one, you just want to start investing in this company and you want a tax break. So you're going to invest, we'll say a decent amount of money. Let's just say you're 28 years old, you've saved up a little bit. So you're going to invest $5,000 in this one company stock. So what happens? This is just like normally investing in stocks. You invest that $5,000, you're locked in for 2 years, and you get a tax deduction, so a tax deduction of $5,000 for that year. Weird, right? This is an actual law which may exist in your country as well. It exists in Canada. Really interesting, right? Now here's something which will be important in about a minute here. The book value, BV, book value, that looks like an 8. That is supposed to be a semicolon. The book value of this is 0. That's going to be important in a second, but for the first 2 years, that does not matter whatsoever. All right, so you invest $5,000 on the book value. So normally after you buy a stock, if you were to invest $5,000, the book value would be $5,000. It'll show up on your stock portfolio account. It'll say your book value is $5,000 right now. But for the purpose of these kinds of stocks, of the flow-through shares, the book value goes to 0. Now we're going to get into year 2 here. Year 2, you see the exact same thing happen. You're going to do the exact same thing. You're investing $5,000. So you get a tax deduction of $5,000 as well. And the book value, BV, is 0 again. So this is normal. You have another $5,000 deduction from your $5,000 investment. So this doesn't look like it's saving you like too much money. Sure, you're going to save, if it knocks you down an entire tax bracket, you're going to save a lot of money. You're going to save maybe $1,000. But right now, this isn't like saving you too much. Here's where it gets interesting. Year 3, let's see if this fits on the camera here. I may have to erase some stuff or write it on the side here. You know what? That's what I'll do right after this. So year 3 happens. So year 3 happens. You are now no longer locked in here. You can now sell this share for whatever it's worth. We're going to say that there's no gain and no loss. So you're going to sell this share for $5,000. So you sell for $5,000. And as you guys know, I talked about the book value here. So technically, you make a $5,000 profit because the book value goes from 0 and it says that you made a $5,000 profit. But that isn't exactly the case. So normally on this, if you were in the highest tax bracket, you would have to pay roughly $2,500 in tax. So we're going to say CG. CG is capital gains. You would have to pay about $2,500 in tax if you're in the top tax bracket. Excuse me. But remember what you can do with that $5,000? You can reinvest that $5,000 into another flow-through share. So year 3, you reinvest it. You reinvest $5,000. And you can keep doing this over and over again. So after year 3, year 4, year 5, year 6, you just get $2,500 in a tax break every single year. Interesting, right? And meanwhile, you don't have to keep putting in more money. You're just taking out the money you had from year 1 and reinvesting it. Now, if that's $6,000, you can have a higher tax break. If it's $7,000, higher, and higher and higher and higher. And you can keep doing this, and it pays off after year 3. So the first 2 years, it's just knocking your tax bracket down, but year 3, 4, 5, 6, 7, 10, 20, 40, all of a sudden it starts to add up. So here after 10 years, this is why it's for young people and not for old people, because it really pays off after 5 to 10 years. So we're going to go up here, year 10. Remember, we only made a $10,000 investment here. So your initial investment is $10K. You invested $10,000 over 2 years. Guess how much money in tax deductions you had over 10 years, just for this? $30K. And this can extend 20 years, 30 years, and all of a sudden, in your entire lifetime from this $10,000 investment, you're knocking down your taxes 50 to 100 grand. So this is why it's for young people. If you were to do this right now, it is risky. The stock could lose a lot of value. A lot of these junior stocks do go out. A lot of these rocket right up. You don't really know. But what I'm trying to say here is that if you invest enough money in the first 2 years, you invest whatever, a substantial portion, $20,000, all of a sudden you're knocking off about 10 grand a year in tax deductions. So for example, we're going to go back to this example here, I guess. Okay, so let's just say you're a young person and you have even more than $5,000. Let's just say you have $100,000. Okay, this is if you're doing really well and you've saved up, you have $100,000 and you invest in this strategy and nothing grows and nothing goes down. You're pretty much saving about $25,000 a year, knocking off from the top line of your tax bracket. So if you're making $50,000 a year at your job, you're technically making $25,000 according to the tax law in Canada. meaning that instead of paying $50,000 would be what, that's about a 30% tax bracket, you'd be knocked from there to like 10% or 15%, something much, much lower. So that'll save you thousands and thousands of dollars in the long run. So this is, you can picture, like, if you have enough money and you just keep doing this and you keep investing in these kinds of stocks, you can see how you can legally pay little to no taxes in Canada. And especially, this is how the super wealthy get around it. I got this from a video I was watching, another video, and it was a guy who was just explaining this, but he didn't connect it to how this could apply to, you know, any investor. He was just explaining the law, I guess. And so this is how, yeah, a lot of wealthy people get around paying taxes in Canada. They just invest whatever profits they make into this, and they just never have to pay taxes. And then when they take out the money, they don't, yeah, again, they don't have to pay any taxes on it. They just keep putting money in here to lower their tax bracket from $400,000 to $50,000 or $100,000. So this is a tax haven for wealthy people. And why do I say it's for young people? It's because it benefits you most if you start this young. If you start this when you're a 20-year-old or a 25-year-old and it's a few $1,000s here, a few $1,000s there, in the long run, that'll save you tens of thousands of dollars in taxes. So anyways, I think that's going to wrap this video up. If you guys have any other tax advantages in your country or even in Canada that I missed, let me know, because I'd be interested to hear about them. This is a non-typical way to save a lot of money in taxes in Canada. So maybe you guys should invest in the Canadian stock market and you guys can get these benefits too. Although the capital gains will be different if you're in a different country. So I think that's going to wrap it up. Yeah, did I miss anything? Let me know in the comments below, and let me know, yeah, if there is a law in your country that that is similar to this. So anyways, I'd like to thank you very much for watching. You're all very beautiful people. I'll see you guys in the next video.